The S&P 500 fell 1.42% today, but the Nasdaq closed flat. If your first instinct is that tech held up well, you're reading it backwards. That divergence is not a safety signal. It is a structural warning about how thin the support underneath this market actually is. Here is the question that matters. When the broad market sells off, but mega-cap tech refuses to move, is that resilience, or is it the last pillar holding up a ceiling that is starting to crack? We are going to answer that with data, not opinion, in the next 12 minutes. Let's start with the number that should be making you think harder than the headline drop. The S&P 500 fell 1.42% today. The Nasdaq finished essentially unchanged, 0.0%. On the surface, that reads as tech resilience. Underneath, it is something more concerning. The S&P 500 is a market cap-weighted index, which means it already has enormous exposure to the same mega-cap technology names that dominate the Nasdaq. If the Nasdaq held flat while the S&P fell 1.42%, that means the non-tech components of the S&P, financials, industrials, healthcare, consumer discretionary, got hit hard enough to drag the index down despite tech's flat performance. We are talking about a broad, synchronized sell-off across the sectors that represent actual economic activity, while a handful of large-cap tech names simply refuse to move. This pattern has a name in institutional analysis: narrowing breadth. And historically, when market breadth narrows to this degree, when the index is being propped up by fewer and fewer names, the statistical risk of a sharper correction increases materially. Research from market structure analysts consistently shows that periods of extreme breadth narrowing, where the top 10 names diverge significantly from the rest, have preceded meaningful drawdowns within 3 to 6 months in the majority of historical cases. The actionable insight here is not to panic. It is to pay attention to breadth indicators, specifically the NYSE Advanced Decline line, and the percentage of S&P 500 stocks trading above their 200-day moving average. If those numbers continue deteriorating while the headline index holds steady, the divergence is widening, not resolving. That is the condition worth monitoring daily, not the index level itself. The VIX closed at 20.1 today, up 16% on the session. That single data point is doing more work than most retail commentary will give it credit for. Let's unpack it precisely. The VIX measures the implied volatility priced into S&P 500 options over the next 30 days. A 16% single-day spike in the VIX does not happen because individual investors got nervous and sold their ETF positions. Options markets are dominated by institutional flow, hedge funds, asset managers, derivatives desks at major banks. A spike of this magnitude means someone with serious capital was actively buying protection today. That is not panic. That is deliberate hedging. The 20 level on the VIX carries specific significance. Below 20, the volatility regime is generally characterized as low to moderate, the kind of environment where risk assets trade with relatively tight daily ranges, and institutional positioning tends to be comfortably long. At 20 and above, the calculus shifts. Historical analysis of VIX regimes shows that sustained readings above 20 correlate with wider daily swings. Increased correlation between assets, meaning diversification starts working less effectively, and a measurably higher probability of gap-down opens. Critically, a VIX at 20.1 is not the same as a VIX at 30 or 40. We are not in crisis territory. We are at the threshold where smart money starts adjusting position sizing and where options pricing becomes expensive enough to discourage speculative call buying. What to watch next? If the VIX recedes back below 18 within the next few sessions, today was a one-day hedging event, and the trend likely remains intact. If it consolidates above 20 for 3 or more consecutive days, that is the signal that institutional sentiment has genuinely shifted, not just twitched. This is not financial advice, but it is the framework that quantitative desks actually use to make sizing decisions. A sell-off is never monolithic. Capital does not simply disappear. It moves. And the pattern of where it moved today and where it came from is where the real intelligence lives. With the S&P down 1.42% and the Nasdaq flat, the selling pressure was concentrated in rate-sensitive and economically cyclical sectors. Financials underperformed as yield curve dynamics remain compressed, and credit spread concerns linger into the second half of 2026. Industrials sold off on continued uncertainty around capital expenditure cycles. Companies in that space have been guiding more conservatively, and markets are repricing that caution. Consumer discretionary followed, which makes mechanical sense. When growth fears spike, the first thing institutional models trim is exposure to sectors that depend on consumer confidence and spending elasticity. Meanwhile, the relative outperformers today were utilities and consumer staples. The classic defensive rotation trade. This is the market's version of a tell. When institutional managers rotate into utilities during a down session, they are not bullish on power companies. They are buying low beta, dividend-yielding assets as a parking mechanism while they reassess their overall positioning. It is a hedge, not a conviction trade. Gold and short-duration treasuries also saw modest inflows, consistent with the risk-off interpretation the VIX data was already signaling. Here is the forward-looking read. If this rotation reverses within 2 sessions, if financials and industrials bounce and utilities give back their gains, today was a technical flush, likely triggered by an options expiry dynamic or a specific macro data print. If the rotation persists into next week, you are watching the early stages of a genuine de-risking cycle, and the positioning implications become more significant. Track the sector ETF flows, not just the price moves. The flows tell you whether institutions are committed to the rotation or just passing through. We started by asking whether a flat Nasdaq during a broad sell-off was resilience or a warning. The data answered it. Narrow breadth, a VIX crossing 20, and defensive sector rotation all point in the same direction. This market is not as stable as the headline index suggests. The follow-up question worth sitting with: what happens to that flat Nasdaq if the 1 or 2 names holding it up finally crack? That is the next video. Subscribe so you don't miss it when the setup becomes clear.